Hey everyone, and welcome back. Today we're taking a look at Chapter 12, the Statement of Cash Flows. Last time we wrapped up our discussion on reporting and analyzing stockholders' equity, which gave us a great understanding of a company's ownership structure and how it's financed. Now we're shifting gears to one of the four essential financial statements that gives us a whole new perspective: how a company actually generates and uses its cash. Think of the statement of cash flows as the financial heartbeat of a company. While the income statement tells us about profitability and the balance sheet shows us financial position, this statement reveals the actual flow of cash. It reports cash receipts, cash payments, and the net change in cash over a period, categorized into three key activities: operating, investing, and financing. When we talk about cash here, it's important to remember that it also includes cash equivalents, those short term, highly liquid, very low risk securities that are practically as good as cash. So, why is this statement so incredibly useful? Well, it provides vital information to help investors, creditors, and others assess a company's ability to generate future cash flows, its capacity to pay dividends and meet obligations, and even the reasons for the difference between its net income and its net cash provided by operating activities. It also clearly lays out the cash investing and financing transactions that occurred during the period. Let's break down those three main categories of cash activities. 1. Operating activities. These are the cash effects of transactions that directly relate to determining net income. This includes the cash inflows from selling goods or services, and interest and dividends received. On the flip side, it covers cash outflows, like payments to suppliers for inventory, to employees for wages, to the government for taxes, and to lenders for interest. Interestingly, items like interest revenue, dividend revenue, and interest expense are considered operating activities because they are reported on the income statement as part of a company's operations. 2. Investing activities. This section focuses on cash flows from acquiring and disposing of long-term investments and plant assets, as well as lending money and collecting those loans. So you'd see cash inflows from selling property, plant, and equipment or investments. Cash outflows would include purchasing these same types of assets or making loans to other entities. 3. Financing activities. Finally, this category deals with cash flows resulting from changes in long-term liabilities and stockholders' equity. Cash inflows here typically come from selling common or preferred stock or from issuing debt like bonds or notes. Cash outflows involve paying dividends to stockholders or redeeming long-term debt or reacquiring capital stock, also known as treasury stock. It's also important to note that some significant activities don't involve cash at all, but they are crucial enough to be disclosed separately. These are called significant non-cash activities. Examples include directly issuing common stock to purchase assets, converting bonds into common stock, issuing debt to buy assets, or exchanging plant assets. These are typically reported in a separate schedule at the bottom of the statement or in a note to the financial statements, satisfying the full disclosure principle. When it comes to preparing this statement, there are two main methods. The indirect method. This is by far the most popular, used by 98% of all companies. It's favored because it's generally easier and less costly to prepare, and it effectively highlights the differences between net income and net cash flow from operating activities. It starts with net income and then adjusts it for items that didn't actually affect cash. While preferred by the Financial Accounting Standards Board, it's less commonly used. This method directly shows the major classes of operating cash receipts and payments. Both methods, however, arrive at the exact same net cash amount for operating activities. Beyond just preparing the statement, we'll also learn how to analyze it. Companies often go through different corporate life cycle phases: introductory, growth, maturity, and decline. The pattern of cash flows from operating, investing, and financing activities will differ significantly depending on which phase a company is in. For example, A company in its introductory phase might show negative cash from operations and investing, but positive cash from financing, as it relies on external funding to build its asset base. Lastly, we'll introduce a powerful analytical tool called free cash flow. This metric provides additional insight into a company's cash generating ability, specifically the net cash provided by operating activities after accounting for capital expenditures needed to maintain current operations and dividends required to satisfy investors. The formula is net cash provided by operating activities minus capital expenditures minus cash dividends equals free cash flow. This tells us how much cash a company has left over for things like purchasing new assets, paying off debt, or distributing more dividends. This chapter is a game changer for understanding the true financial health and flexibility of a business. As you dive in, remember to utilize the guided notes and lecture videos available in Wiley course resources. They're fantastic tools to help you reinforce these concepts. Next up, we'll be pulling everything together in financial analysis, the big picture, where you'll get to use all the tools you've learned so far to really evaluate how a company is doing. But for now, take your time exploring the world of cash flows. It's such a powerful way to understand what's really happening behind the numbers. You've got this, and I'll talk to you soon.